Today we start topic 8. Topic 8 will be the last topic in the course, and it consists of two parts. The first part deals with depreciation. If you look at the title of the topic, it says depreciation and return to the accounting cycle. The second part of the topic will deal with coming full circle. If you remember, we started the course with income and balance sheets, the financial statements, and now we will go back to those two statements and show how information from our journal and ledger ends up into those two financial statements. The first part of the topic deals with depreciation. Depreciation simply means a decline in value. Most assets will eventually decline in value. There are some exceptions. Land, for example, may actually increase in value, but for the most part, assets will decrease, and that's what we will be considering today and the next couple of days. So, on your screen, you see a general journal for the ACE Delivery Company, and you see a transaction that should be fairly familiar. We've had this a number of times. The company on January 1 of 2018 bought a delivery truck for $65,000, and they took out a loan for most of it for $55,000, paid cash for $10,000. Very common type of transaction. Let's take a look at the ledger accounts. At the bottom, you see the tabs as we've had before. And in the general ledger under cash, we see that at the end of 2017, we had a balance in cash of $175,000. Now, the next day, January 1, we spent $10,000 on the delivery truck, so we credited. Very simple. Here's the delivery truck account, and it's debited by $65,000. What's important here is the bottom, or the account right below the delivery truck. A new account called Accumulated Depreciation Delivery Truck. And this is something called a contra account that I will be explaining in a few minutes. It's associated with the delivery truck. The account number shows us that. The account number is 103.5, which is connected with account 103, which is the delivery truck. So we will come back to that. Under liabilities, nothing in accounts payable. Not dealing with that in this problem. Remember, accounts payable deals with liabilities that typically are due within 30 days. We've taken out a loan, so we use the loans payable account for our truck, and loans payable are long-term liabilities, in this case probably 3 to 5 years long. So we owe $55,000 now because we took out that loan. We're not using owner's equity in this problem. We're not using revenue, but we are using expense. Under our expenses, we see some typical ones: salary expense, telephone expense, utilities expense, and here's a new one: depreciation expense for the delivery truck. And we will be considering that in a few minutes. So account 504 is an expense account called depreciation expense for our delivery truck. Now, let's go back to the journal and look at how we will do this. We are going to rely on something called straight line depreciation. That means that we will make an educated guess as to how long we will have this delivery truck and what it will be worth at the end of its useful life. So this follows what we termed way back at the beginning of the course, something called GAAP, Generally Accepted Accounting Practices. The straight line depreciation method is one of the types that's generally accepted in the accounting field. There are other ways of depreciating assets, but this is a simple one that we will be using in this course. So what we are doing is making an educated guess that this delivery truck that we're buying on January 1, 2018 is going to last us 10 years. It was valued at the beginning with $65,000. It could be new, it could be used, but the value when we bought the thing is $65,000. So the second thing that we will assume is at the end of the 10 years, there will be what we call a salvage value or a trade-in value. So at the end of 10 years, the delivery truck is going to still be worth something, and we will trade it in, and it will give us some value. Sometimes it's called trade-in value, as I said, or salvage value. In this case, we're going to assume that at the end of 10 years, this truck is going to be worth $2,000. So the straight line depreciation is figured like this. We will take the purchase price, $65,000. We will subtract what we consider to be the salvage value of $2,000, leaving $63,000. That's the amount that we would depreciate over the course of 10 years. So very simply, take the $63,000, divide it by 10, which means each year the delivery truck will depreciate or lose value in the amount of $6,300. Now, we could be doing this monthly, we could be doing it quarterly, 4 times a year, or we could be doing it annually. To make it very simple in this problem, we will assume that the ACE delivery service has an accounting cycle of 1 year. So at the end of the year, we have to account for that $6,300 loss in value of that delivery truck. Let's assume that today is December 31st, 2018. So at the end of the year, at the end of this accounting cycle for this business, we need an entry to allow or to account for that depreciation. The account we will use is one of the ones I showed you a moment ago. Oh, I'm sorry, I'm on the wrong line. Pardon me. Let's go down here. So we will debit an account called depreciation expense for the delivery truck. That is a debit. And we said that each year it declines in value of $6,300. So this is one of our costs of doing business. This is an expense of the business. The asset declines in value. The credit in this entry is accumulated depreciation delivery truck, and that will be credited. So that's the journal entry. Okay, let's post that. The debit goes to an expense, depreciation expense for delivery truck. Let's go to this new depreciation expense account. And that's debited by $6,300. As with all expenses, this will end up on our income statement. That's where expenses are shown as far as financial statements. I have to check my journal page. This is J15, and the account is 504. So we put that account number in, and the credit part is accumulated depreciation, $6,300. That is the contra account. That is listed under assets, but it's called a contra account, which means opposite, actually. That's a credit of $6,300. And again, that comes from journal page 15. And you notice that the account number is 103.5. Now, this will end up on the balance sheet, as we'll see in a few minutes. But you can see that at the end of 1 year, we bought this truck for $65,000, and we have a credit of $6,300. If you subtract the credit from the debit, you'll see at the actual value of that delivery truck at the end of 2018. So let's go back to our journal and put in the account number. So this is what we call an accounting entry into the journal that has to be done at the end of each accounting period. So this is at the end of the year. If we were doing this every month, we would have to take that 6,300 divided by 12, which gives something like $525. So that would have to be done every month if this business has a monthly accounting cycle. In this case, we said it has a year, so we use the full 6,300. So that's what we'll be dealing with for the next few problems in this course. And I do want to show you at the very bottom at the tab, I've also added the balance sheet. And we're not going to fill this in, but the thing that we will look at here is the fact that not only does it show delivery truck, which would be for this balance sheet, 65,000, but we will also show the balance of the contra account, and would have to be minus $6,300. So someone looking at it can see that the asset was valued at the beginning of 65,000. Accumulated depreciation, which was a credit back in account number 103.5 is 6,300, and you can see how much it has declined in value. If this was December 31, 2019, the accumulated depreciation will be double this, will be 12,600. So you can see each year that will increase, showing us that the original value minus the decrease in value because of depreciation will show a lesser amount for that delivery truck. So this entry back in the general journal is an important entry that has to be done, as I said, at the end of each accounting cycle. At this time, I'd like you to go back and answer the questions that follow this video.